Ladies and gentlemen, thank you for standing by. Good day and welcome to the Alston and Bird Tax Talks. This session is an update on qualified opportunity zones. Today's conference is being recorded. At this time, I would like to turn the conference over to Scott Hardy. Please go ahead, sir.
Thank you. Good morning, everyone. Thank you for dialing in this morning. Again, my name is Scott Hardy. I'm a partner in the Federal and International Tax Group with Alston and Bird. And before we get started, I just want to give a brief overview of the series of tax talks that we're starting today. So since late last year and then through the beginning of this year, the IRS started releasing quite a bit of guidance and proposed regulations in connection with the Tax Cuts and Jobs Act. And obviously there's a lot for everyone to digest. So earlier this year we began hosting a weekly series in which we gave summaries of the regulations and the guidance for clients, and really we were issue spotting on behalf of clients. And then that series ended in April, and we felt that it would be helpful to continue having at least monthly updates since we have this ongoing release of guidance, final regulations, whatnot. And so today we're starting that series up again, and clearly there's a lot for us to discuss. There will be a lot for us to discuss over the coming months. If you just look at what came out on Friday alone, we got final regulations for GILTI, regulations under 245 Cap A, and then proposed regs for a GILTI high tax exception and 958 DFC determinations. There's just a lot coming out. That was just on Friday, and more is anticipated. So given kind of this consistent release of information, we're hoping to have these monthly updates. And really what they're intended to do is just to address recent guidance, relevant issues that we're seeing, that we want to share, recent developments, whether they be judicial or administrative. And so from month to month, we're going to be doing that. And just to preview next month, we are going to take a look at the recent Altera decision in the Ninth Circuit, as well as a case coming out of the Supreme Court this month, Kaiser v. Wilkie, which implicates Chevron deference. And we want to focus on the federal and state implications and really kind of this broad-scale attack on deference that we're seeing in the courts. So that should be interesting and an issue that we're seeing for our clients. But this morning, I'm joined by Branson Lee, and Branson is a senior associate in our Financial Services and Products Group, and he is here to discuss recent developments in opportunity zones, which continues to attract a lot of attention. And in terms of format, what we're going to do, Branson's going to initially kind of level set, review the program and the benefits to investors, and then turn to issues addressed in the most recent proposed regulations. So just administratively, we've blocked off an hour for these talks. We may not go that long, but we have blocked off an hour. As always, we do welcome questions, so we intend for this to be at least somewhat interactive. If you have questions, you can just submit those on your screen at any time. You don't have to wait till the end. Just send an email. There's an Ask a Question box, or should be on your screen, and you can send those. That'll come directly to Branson and myself. Hopefully we can answer your question. If we can't during the call, then we will get you a response after the call. And then these presentations will be provided on our website afterwards, just in case you wanted to access the slides or listen to them afterwards. And we will send out an email later today. So just a quick introduction so we can get started. Branson, as I mentioned, is in our FISAP group. He advises REITs and other alternative investment vehicles on tax and securities matters relating to structuring, formation, and M&A. And Branson also counsels fund sponsors and developers on structuring funds and investments in qualified opportunity zones. So Branson, I thank you for being with us this morning and presenting on this topic. And with that, I'm going to turn it over to you.
All right, thanks, Scott. So I will try my hardest to keep this well inside of an hour. And so we'll just dive right in with the sort of, as Scott mentioned, the roadmap today. We'll just give a brief overview of the program and the benefits for those who may not be intimately familiar with it. We'll do an overview of some of the key definitions, and then we'll jump into sort of the issues addressed by this most recent tranche of regulations. So the program was enacted as part of the Jobs Act. So it's been around a year and a half now, intended to encourage investment in qualified opportunity zones, which are low-income census tracts designated by the states. Those areas cover 11 or 12% of the country's landmass, so it's significant. And at a very high level, the potential benefits to investors for investing in qualified opportunity zones, assuming all other requirements are met, are deferral of gains invested in those zones until up to December 31, 2026, a 15% basis step up if the investment is held for 7 years, and exclusion of the gain from appreciation on the investor's interest in the Qualified Opportunity Fund if it is sold after 10 years, a 10-year holding period. There may also be state tax benefits to be had as well. So just for, and we kind of hit this example on the next slide in the last presentation, but this just kind of runs through an investor who sells property for $10 million and realizes a $1 million gain and then invests that in a qualified opportunity fund and sort of the benefits that investor realizes. And you can kind of see there the basic numbers. Investor initially takes a zero basis in the $1 million interest it acquires, and then after year 7 has a basis step up from 0 to 150,000. So 150,000 of that $1 million gain will never be taxed as a result of that basis step up. On December 31, 2026, the investor recognizes the remaining $850,000 of the original $1 million gain rolled into the QoF. And then on sale after 10 years, I think this example assumes there was $1 million of appreciation in the QoF interest, and that $1 million gain is not taxed. So just a very kind of basic example to illustrate the benefits available to investors. So on the next slide, we'll just start to set out a couple of the very basic definitions here. And that is sort of where, the definitions are where the rules lie. So the key definitions are Qualified Opportunity Fund, which that's a QoF is what we'll refer to it as. We'll also talk about Qualified Opportunity Zone Business Property, or QoZ BP. And we'll talk about Qualified Opportunity Zone Businesses, QoZBs. So those are sort of the abbreviations you'll see. So to start with the QoF, that is an entity that's been formed as a partnership or corporation, could be a REIT or an S-Corp, and it's self-certified as a QoF by filing 8996. And so this is a sort of benefit of right program where this self-certification is what makes the program so attractive, is that if you meet these requirements and the QoF can self-certify, then the benefits should be available to those taxpayers. So the QoF, aside from self-certifying and being formed as a partnership or corp, will have to meet a 90% asset test. On certain dates, at least 90% of the QoF's assets must be QoZ property or QoZP. And that includes an equity interest in a corporation or partnership that is a QOZB or QOZ business, and we'll get to that definition in a minute, or the QOF can hold QOZ business property or QOZBP directly. Those test dates are generally the end of the first 6-month period of the QOF's status as a QOF, and then December 31 of every tax year. Let's go on to the next slide and look at the two sort of basic structures. So in all cases, you'll have a taxpayer investing in a QOF, and then the QOF will either, to pass that 90% test, will either invest in a QOZ business, which is shown on the left, and so that's a partnership or corporation that qualifies as a QOZ business, and that QOZ business will invest in QOZ business property. So that's on the left. On the right is the QOF that invests directly in QOZ business property. So let's go to the next slide and talk about QOZ business property and what that is.
Hey, Branson, just real quick, for those who may be joining now, if you want to access the slides, if you want to flip back through the slides, if we were going too fast, you can access those under the Event Resources section on your screen, and then you can kind of control the slides and the movement if you want to go back at all. So I just wanted to make sure that everyone was aware of that. That's it.
Yeah, thanks, Scott. And we'll try to move through these quickly because I'm sure a lot of our listeners have heard the same thing 100 times. So the QOZBP definition, that is tangible property that is used in a trade or business of the QOZ business or the QOF if it's holding directly. That property must be acquired by purchase, so not in a carryover basis transaction, from an unrelated party, and that's a 20% threshold for related party status, after 2017. These new regulations also provide that leased property can be QOZ business property in certain circumstances. In addition to those requirements, the QOZ business property or the property must be substantially improved, or the original use of that property must commence with the QOZ business. And we'll talk about each of those in turn. And then finally, the last requirement is that during substantially all of the QOZ business entities holding period of such property, substantially all of the use of the property was in a qualified opportunity zone. And we know that from these new regulations, substantially all of the holding period means 90%, and substantially all of the use means 70%. So let's go to the last kind of overview slide, the definition of a QOZ business. And so this is looking at a partnership or a corporation that seeks to qualify as a QOZ business. So that is, the elements of that definition are a trade or business. That's we know now from these new regs, that's a Section 162 analysis. Substantially all of the tangible property owned or leased by the QOZ business is QOZ business property, and we just covered that definition. There's a requirement that 50% of the gross income of the entity is derived from the active conduct of the trade or business in the QOZ in which it operates. There are safe harbors under these new regs provided for that 50% test, which we'll hit on. And again, the active conduct of the trade or business is under 162. We'll get into that a bit more later. Any intangible property held by the QOZB. So a substantial portion, or 40% of the QOZB's intangible property, must be used in the active conduct of such business of the QOZB. Non-qualified financial property must be less than 5%. That is property like cash, stock, and certain notes. There are exceptions for that. for reasonable amounts of working capital, which we'll get into a bit later. And finally, a QOZB must not be a sin business, such as a country club, massage parlor, or golf course. And those are specifically enumerated in the statute. So there's our kind of groundwork. Again, the slides are, feel free to sort of come back to that or ask us questions later. From here,
Branson, I'm not sure. Sorry to interrupt just real quick. We did get a question about the taxable benefit and whether the property is the taxable benefit and not other business income for the company operating in the qualified opportunity zone. Not sure if you...
yeah, so let me see. The property is the only taxable benefit. So, yeah, I think the question is whether the sort of operating income there would be no tax on that income, and that is not the case. So let's take an example where you invest in a partnership. You invest $100 and that partnership begins business and starts generating operating income and profits and generating taxable income. That taxable income will flow up to the investor, and the investor will pay tax on that. So the benefit is limited to deferral of that original gain, the basis step up, and exclusion from the sale of the QoF interest or certain asset sales by the QoF, which we'll get into.
Okay, hopefully that answered, that question. Thank you.
So going forward, I've tried to sort of divide the issues addressed in these new regulations by the issues addressed that you might think of at the investor level, the QoF level, the QOZB level, and then finally we'll touch briefly on sort of the inclusion events that the regulations defined. So the first sort of topic, 1231 gains. So the framework here is that investors can invest eligible gains into a QoF and defer tax on those gains. So eligible gains are generally capital gains and include 1231 gains. These new regulations provide that only net 1231 gains can be invested in QoF. That netting generally happens at the end of the year. So if you have 1231 losses and the same amount as 1231 gains, then you have no net 1231 gains, and that determination is made at the end of the year. These regulations, for that reason, say that the 180-day period during which your investor must invest those net 1231 gains begins on December 31. That rule is significantly less flexible than rules for example, an investor who will see a capital gain on its K1 from a partnership, especially if that investor controls that partnership. In that case, the investor can elect essentially to invest within 180 days of the partnership's gain realization event, or invest within 180 days of the year end for the year during which that gain realization event occurs. So here we have a scenario where, for example, if an investor has a 1231 gain in February and knows that it won't have any 1231 losses and is fairly confident that, for that reason, that it will have a net 1231 gain, the investor's sort of out of luck. If an investment comes up, say, in June, and investor has to either make the investment or pass on it, it's not a good scenario for investor because that investor would like to invest those gains in a QoF, but its 180-day clock has not started yet. So it's generally not a favorable rule, and a lot of investors are sort of having to deal with that and try to work around it.
You did, Branson, is that a situation where, I mean, you potentially just miss out on an investment that you otherwise think would be a good investment for you to make and to take advantage of this? Or is there alternatives to that?
Yeah, well, if your 180-day clock has not started, one obvious alternative is to just make the investment and don't elect to defer gains because you're not within your 180-day period. The other sort of alternative is to try to get to a place where your 180-day clock is going to start on December 31, but you want to make the investment now, and so there are a couple ways that you might consider structuring to do that. One of those ways, for example, is to make a debt investment in June when the opportunity arises. That's obviously very different from an equity investment. So if you're in a joint venture which is really, I think, the main context where you might have this sort of flexibility, you would have to convince your partners to allow you to make that debt investment instead of an equity investment, and it would have to work with your sort of other sources of financing. But the idea would be that you make a debt investment in June, and then on January 1, after your 180-day clock has started and you're allowed to invest those eligible gains in equity of the QOF, you invest those eligible gains in equity, and the QOF turns right back around and pays off the debt investment that you originally made. And so assuming that initial debt investment is respected, that could get you there, but you would want to think carefully about whether that investment would be respected. Another sort of possibility, I think, is to say debt's not an option, form a partnership and have the partnership just a captive partnership. So you are the person with eligible gains, you're the 99% partner, and you form a corporation to serve as the 1% partner. Have the partnership acquire equity in the QOF, and then on January 1, after your 180-day clock has started, buy out the partnership's interest in the QOF with your eligible gains. And so I think that is, you're basically sending cash in a circle again. So you want to be careful with that the IRS would respect that and you don't want to think hard about the sort of anti-abuse rules. But under the literal reading of these rules, that can get you there as well.
Okay.
So I think there is some flexibility, but what we would like to see is a rule that would allow us to start that clock at another time. So the next sort of issue addressed at the investor level is so these regulations said that investors can transfer non-cash property to a QOF in exchange for an interest in the QOF and have that be a qualifying investment. That can happen in a taxable transaction or a non-recognition transaction. I will say, though, that particularly in the non-recognition transaction, it doesn't seem like this rule will be is very useful because, first of all, to be a good asset in the hands of the QOF has to have acquired that asset by purchase, which would not be the case if the QOF acquired the asset in a carryover basis transaction like a 721 contribution. Additionally, if you're in the more common structure where QOF holds equity interest in a QOZ business, and so somehow needs to get that contributed property into the hands of the QOZ business, the interest it receives in exchange for the transfer of the property to the QOZ business would not seem to be a good asset either, because it hasn't been acquired from the QOZ business solely in exchange for cash under the statutory requirement. So this rule seems of limited use. So we won't spend much time on that. Another point in these new regulations was the receipt of the QoF interest in exchange for the performance of services. So think carried interest. These regulations made it very clear that an interest issued in exchange for services is not a qualifying investment. So say, for example, you have a general partner developer sponsor that contributes $100 to the deal and then takes a 10% capital interest with a 20% promote on the back end. It is possible that if a portion of that promote is recharacterized or the capital interest is recharacterized as received for services, the $100 will not be a qualifying investment. Only a portion of that $100 will be a qualifying investment. So that presents sort of a problem from if you set up a standard joint venture development structure like that, you're kind of boxed in with this issue to deal with.
Mm. I mean, I assume a lot of people are interested in that. Is there a way to kind of address that issue, or is that carried interests are obviously important to a lot of these structures, so are there alternatives there as well?
Yeah, so a couple ways, and I think in all of these you want to be really careful about with the anti-abuse rule, and you want to make sure that there's substance behind this. But one of the more sort of obvious alternatives to taking an interest that is at risk of being characterized as received in exchange for services is instead of taking a carried interest, take a fee. And so you developer sponsor invest alongside your other equity investors on the same terms, and then your sort of promote or incentive allocation in the deal is structured as a fee and not an allocation. So that's one way. Another sort of way to think about this is if you have a developer or sponsor that is willing to contribute equity and subordinate that equity to the other equity in the deal, then I think you have at least an argument that any additional interest received by that sponsor on the back end, instead of being received for services, it's actually received because that equity is the common equity and the other equity is more like the preferred equity. So that, the argument there is that the money was subordinate, and so it gets a larger share of the back end profits. So that's another option. You could also form a separate entity to take the promote at the qualified opportunity zone business level, but that you still have the sort of possibility that, well, you still have the cash that you invest at the QoF level would not then be considered received in exchange for services, and then the QoD business promote that you've been issued is obviously you're receiving that in exchange for services, so there's no sort of deferral election associated with that. So there are a few options there. The next sort of item that the proposed regulations addressed was the basis step up on the sale of a QoF partnership interest. And that basis step up occurs immediately prior to the sale. And so that rule is very favorable and eliminates the concern that an investor who sells in year 11 its interest in the QoF will will be allocated and have to recognize ordinary income from hot assets, which was a major concern. And so now we know that there's an inside basis step up as well, and that investor sells and has no recapture, and there's really no concern over hot assets. That is, so we'll get to this in a minute, but that result is a bit different in the context where the QoF sells its assets as opposed to the investor selling its interest in the QoF. Where the QoF sells its assets, there's a rule that now in these new regulations provides that investors can make an election to exclude that gain, assuming they've held their investment for 10 years. And so you would think that it's sort of trying to mimic a scenario where the investor has sold its interest in the QoF, and so you would think that depreciation recapture, the investor would not be hit with that, but the rules where the QoF sells its assets are actually pretty clear that exclusion only applies to 1231 net capital gains. So would not apply to 1245 recapture, for example. So we'll try to put that into context on the next slide a little more. So we already kind of touched on this next one where we were talking about the 1231 and gains and kind of how you might structure around the 180-day rule. But these new regulations provide that an investor can acquire a qualifying interest in a QoF by purchasing that interest from an existing investor in that QoF. So a purchase on the secondary market, essentially, as opposed to the investor contributing cash directly to a QoF for the QoF's original issuance of an equity interest. So that allows some very favorable flexibility. One thing to sort of think about definitely as an investor there and to be careful of is if you as an investor buy into a deal 2 years after it started, and the intent is for the QoF to hold its assets for 10 years and a day at least, so that the initial investors will have the benefit of exclusion after 10 years. The investor that came in year 2, by purchasing an initial investor's interest in the QoF, your holding period is not tacked onto that initial investors. And so your holding period on 10 years, while other investors have held for 10 years and 1 day, you will have held for 8 years and 1 day. So you'll want to be careful and kind of look at the governing documents and the restrictions on sale if you're buying an interest after or on the secondary market. So finally, the regulations address debt finance distributions. So these regs made clear that a partner's basis in its partnership interest in a QoF includes its allocable share of liabilities under the normal subchapter K principles. And so that permits debt finance distributions. So an investor initially takes a zero basis in its QoF interest, assuming its entire investment is a qualifying investment. And then that QoF levers up. That investor can receive a distribution up to the amount of the liability that is allocated to that investor and thus included in its basis without triggering an inclusion event. There are rules that apply to those distributions, and particularly any distributions made to the investor within 2 years of the investor's contribution of cash to the QoF. And it's sort of a modified disguised sale analysis. So in general, to be very careful, you would want to limit distributions, even debt finance distributions, within 2 years of contribution. If that is just not an option, then you'll want to take a careful look at the disguised sale rules and see if you feel comfortable that you can overcome the presumption of disguised sale for distributions within 2 years. So on the next slide, we'll talk about some of the sort of QoS level issues addressed. The first one was a pretty straightforward and favorable rule. That rule provides that a QoF that receives cash can basically ignore that cash for purposes of the 90% test for 6 months. So if QoF receives cash on February 1st, and then it has its first 90% test in June, the test in June will basically ignore the cash that it received in February, and so that gives the QoF up until the December 31 90% test to invest that cash that it received in February in QOZ property. And so in most cases, it will invest in a QOZ business that will have a written plan under the working capital safe harbor to spend that cash within 31 months. So sort of just a straightforward 6-month extension of the time to find an investment. These regulations also make clear that a failure of the 90% test sort of on the first test date does not mean that the QoF is not a valid QoF and your deferral election was not a valid deferral election and your investment was not a qualifying investment, which would be, that's sort of the atom bomb scenario. Instead, the penalties will apply, and the QoF will have the opportunity to satisfy the 90% test at a later date. There were a couple new rules in these regulations that apply to, in the case where you have asset sales by a QoF. So in the first rule, the regulation said if a QoF sells QOZ property, then it has 12 months to reinvest that property and to reinvest the proceeds from the sale. So during that 12 months, say a QoF with one asset sells the asset, and all of a sudden it's holding all cash and no QOZ property, and it might fail the 90% test. This rule says to the extent that the QoF actually invests in QOZ property, invests those proceeds in QOZ property within 12 months, during that 12-month period, the cash will be treated as QOZ property. So it will not cause the QoF to fail the 90% test. That's a great rule. However, any sales of appreciated assets will be taxable. This is not a rule that says QoF can sell an appreciated asset and exclude the gain realized on the sale of that asset. So in the context where you have a QoF that is holding a portfolio of appreciated assets, this rule is, I would say, not likely to be particularly useful, assuming the ultimate goal is to achieve exclusion of the gain in those assets after 10 years. So it's not an unfavorable rule to taxpayers, but it certainly could have been better. So the next sort of set of rules for asset sales applies where investors have held a QoF interest for 10 years. And so we already talked about the context where the QoF sells its asset, and the investor can elect, if it's been holding for 10 years, to exclude the gain on that asset sale. The issue there is that the investor can only elect to sell the 1231 net capital gain income. And so if there is 1245 or 1250 recapture, the investor will not be able to exclude that. So a note just on 1245 recapture and 1250 recapture. In the real estate fund context, you're unlikely to have a lot of 1245 recapture. That's recapture of depreciation on personal property. 1250 deals with real property, and the recapture under 1250 is only applicable to depreciation in excess of straight line depreciation. So in most cases, it should not be substantial. So the other sort of complication and less than ideal rule for a sale by a QoF of its assets is that the option for an investor to elect to exclude the gain applies only for the sale of a QoF of QOZ property. So in the scenario where a QoF owns a QOZ business, which owns QOZ business property, you can't have this rule does not apply if the QOZ business sells its property. So in the typical real estate context, you would sell the assets. The QOZ business would sell the assets, the real estate, which is the QOZ business property. If that happened and an investor had been holding more than 10 years, this rule allowing it to elect the exclusion of the gain from that asset sale would not apply. So there are, a couple of ways that you might try to sort of get around that. Number one, you might try to have the QoF sell the interest in the QOZ business. You'd have to find a buyer willing to buy interest in an existing entity. There would probably be some indemnification involved there if you could find a willing buyer at all. Another option would be to have the QOZ business distribute the property to the QoF in liquidation and in a carryover basis transaction, and then have the QoF sell the real estate or the QOZ business property directly. That may give rise to transfer taxes and you'd want to think carefully about that before you went down that road. A final option is, and this option actually addresses the sort of structuring option to address the 1231 issue. The idea here would be to have investors buy into a QoF and then take advantage of the new rule that says those investors can contribute their interests in a QoF to a feeder partnership. So now you would have investors owning interest in a feeder partnership which owns a QoF, which owns a QOZ business entity. And you could then have that feeder partnership sell the interest in the QoF to a single buyer. Again, you'd have to find a buyer willing to buy interest, but that sort of restructuring for the sale after 10 years would get you to a place where you've sold interest in the QoF. So your basis step-up provisions would apply to get you around the potential 1245 and 1250 recapture issues. So that's another sort of structuring option to consider on the front end. So on the next slide, and I know we're getting down to just 10 minutes or so left here, so we'll try to move through this a little more quickly. But on the next slide, we have a set of issues addressed at the QOZ business level. And so the first one here is sort of the active conduct of a trade or business, and there was a big question about what that means. The regulations and the statute, neither one of them said what a trade or business means or what the active conduct of that trade or business means. So there were a lot of questions around that. These regulations basically said look to the Section 162 analysis, which I know, Scott, just as a in your day-to-day, year-to-year practice is something that you come across probably pretty frequently, and I know it's in the 199A reg. Did you want to say a few words about that?
Yeah, I think yes, the 199 Cap A regs or the preamble discusses this as well, referring to kind of the 162 definition of a trade or business, which basically says you get a deduction for your ordinary necessary expenses incurred in carrying on that business, but you really don't have a definition of what a trade or business is, and so it's just a highly factual determination. There's an entire body of case law devoted to this, and I think one of the issues is just the uncertainty for taxpayers of what's the precise meaning of a trade or business, and I think certainly there's an indication that leasing activities are permitted, but something more than just entering into triple net leases. There needs to be something more than just that. Query what that is, but at least in terms of the trade or business determination, the case law essentially looks to your profit motive, that it's a considerable, regular, and continuous activity, and I think basically the taxpayers are going to have to go back to the case law and make this determination, and the real rub is going to be possibly on the leasing activities. But anyway, yes, highly factual determination and not entirely clear.
Thanks, Scott. So definitely something to consider on the front end. The next sort of point here was the safe harbors in the regulations for the 50% gross income test, and that is the requirement that a QOZ be have at least 50% of its gross income come from the active conduct of a trade or business in the zone. And so a lot of people were saying, well, what does that mean? What if you have the classic example is a manufacturer in the zone manufacturing widgets and then selling those to buyers outside of the zone? Is that a problem? Because, what if all of the buyers are outside of the zone? Is 50% of your gross income then not from the active trade or business within the zone? So these regulations gave 3 safe harbors for making that 50% of gross income within the zone determination. The first 2 safe harbors focus on services performed by employees and independent contractors, and one is based on hours of those employees, hours of the services that are performed within the zone. The second focuses on the amounts that the QOZ business pays for those services that are performed by those employees and independent contractors within the zone. One question there is sort of, how do you deal with employees that travel? How do you get this, in the case of independent contractors, how do you get this information from them? If it's not sort of industry standard already to have independent contractors providing this information, for example, how many hours are they working in the zone, then the QoS or QOZBs now have to require that additional information from independent contractors performing services for QOZBs. So there's some questions around exactly how that's going to be implemented, but on the whole, we're better off with some safe harbors than none. So those are the first 2 safe harbors, and the third safe harbor applies where the tangible property of the business or the QOZB in the opportunity zone and the management or operational functions performed for the QOZB in the opportunity zone are each necessary to generate at least 50% of the gross income of the business. So think about a property management company with its offices located in the zone. I think and management sits in those offices. In that scenario, you probably meet this third test. So I think this third test is probably a bit more subjective and easier to make arguments that you fall within it. But if you fail to satisfy any of these three safe harbors, then you can always fall back on the facts and circumstances analysis. So hopefully these safe harbors will prove, and I think they will, to be very useful for operating businesses hoping to take advantage of the Opportunity Zone program. So the next sort of point on here was, again, I think intended to make it a lot easier for operating businesses to take advantage of the Opportunity Zone program, and that was the expansion of the working capital safe harbor. Previously, that applied only to cash that was designated in writing for the acquisition, construction, or substantial improvement of property, and so that it reads like real estate. Now, the working capital safe harbor under these new regulations applies to amounts designated in writing for development of a trade or business in the qualified opportunity zone, including the acquisition, construction, or substantial improvement. So think about some of the examples that are provided are a startup business that has set aside funds to not construct a building, but instead hire and train staff and obtain necessary permits. R&D activities are included, salaries are included. So it's much more sort of geared towards operating businesses now. The working capital safe harbor new language also makes clear that there can be sequential and overlapping 31-month periods or working capital safe harbors for cash that comes in at different times. So you have cash come in month one, you have 31 months and a plan for that cash. And then if you have a QOZB has a subsequent round of equity financing in 20 months, then you have a separate sort of 31-month plan for that new cash that you raised after 20 months. And so that is very, very much, I would say, in line with how startup businesses are typically financed in the beginning. It's, you've got your A round, your B round, and you basically go until you run out of runway and need more money. And so that's exactly how I think this working capital safe harbor and the sequential applications of that will end up applying to operating businesses.
Hey, Branson, just real quick on that. We're about 5 minutes out, so I wasn't sure if we want to jump to the last slide or just make sure you hit on your high topics before we conclude.
Yeah. So I think just to hit really quickly on leased property, the rules for leased property were very taxpayer friendly. Leased property can qualify as QoD business property. There is no original use or substantial improvement requirement, and there are additional rules applicable to leased property from a related party, but even property leased from a related party can, if it satisfies those rules, qualify as QoD business property. So I think that gives taxpayers a lot of flexibility in various scenarios. Existing landlords may be able to help their tenants take advantage of this program by renewing leases. This may be a way to deal with the rule that I don't think it's 2 bullets down. The rule that substantial improvement is determined on an asset-by-asset basis, not the rule that we were hoping for, but the leased property rules may be one way to sort of work around that and deal with challenges prevented by that asset-by-asset determination. So very favorable rules there. Got a pretty good rule for raw land, and sort of not unexpectedly, there are requirements aimed at preventing abuse and land banking. So raw land used in a trade or business is QoD business property. So that was comforting to get that rule. So the last slide here, and I know we're kind of running out of time. These regulations set forth and sort of defined inclusion events. The issue here is that under the statute, deferral ends on the earlier of December 31, 2026, or the date on which the investor's investment in the QOF is sold or exchanged. Exchange is a really broad term under the tax law, and so it was causing some concern. And these regulations basically sort of narrowed that term for us and defined what would and would not constitute an inclusion event. So we are 1 minute to noon, so I'll stop there and encourage people, though, to please, with any comments or questions, reach out to me or Scott. Always glad to kind of talk about any of this stuff.
Brinson, that's great. Just a couple of quick questions or points. So one person asked who the typical investors are in opportunity zones. Any thoughts on that? Just typical investor profile?
Yeah, so I think you'll see a lot of sort of wealthy individuals making these investments. Technically, there's no size limit here on the investment. So technically, you could have someone who has a $5,000 capital gain interested in taking advantage of one of these investments, but that's just not, we're not seeing a lot of that. You're more seeing people with $1 million, $2 million capital gain who have tax advisors advising them and sort of access to investments like this. So for the most part, I'd say wealthy individuals. What I think a lot of people are hoping to see is enterprises and entities like investment funds start to try to take advantage of this, because entities, including partnerships, can invest in qualified opportunity funds and defer gains that way and make a qualifying investment. But so far, a lot of it has been wealthy individuals.
That's helpful. One other thing I think, which is probably very important to a lot of people, but I want to respect their time, is just the drafting of the relevant documents, the governing documents for these entities. I mean, I'm sure there's a host of considerations that you need to take into account for partnership agreements and relevant provisions. Just can you give a 60-second version, and maybe we have a follow-up with a slide of some of the relevant considerations that we can share?
Yeah. So I think from, there are two angles to look at it. There are two lenses through which to look at it. One is an investor's viewpoint, and the other is from a sponsor's viewpoint. And so the most obvious, if you're an investor, is what kind of undertaking is the sponsor making to cause the entity to qualify as a QOF? And I would think that you would want to at least see sort of a reasonable effort standard. Sponsor will use reasonable efforts to cause the entity to qualify as a QOF. You probably also want to see some sort of restrictions in the investment mandate of the fund or the entity to invest in qualified opportunity zone property. Importantly, you would want to see as an investor some sort of restrictions or limitations on the ability of the QOF to sell assets prior to the date that is 10 years from the date of your investment or the QOF formation. from the sponsor's perspective, you'll definitely want indemnification for failures to qualify. Any failure to qualify as a QOF, there's a lot of uncertainty here, and as long as that failure did not occur as the result of negligence, then I think you have a good position as a sponsor that any failure to qualify you'll be indemnified for that, and you're not sort of guaranteeing tax results. So I think those are the big things, and then there are sort of a list of technical requirements in these documents, like the working capital safe harbor written plan, and the purpose provision of these documents to make very clear that the purpose is to invest in qualified opportunity zone property. But I think the big ones we've hit.
That's really helpful, and I think we will upload these slides, and maybe we can incorporate some of those considerations into the slide deck when we upload them. So Branson, thank you very much for that. I apologize for going a little bit long today, but everyone, thank you for dialing in. If you have questions, feel free to reach out to Branson, and he will get back to you. And just stay tuned for next month's tax talk on Altera and the recent Supreme Court or upcoming Supreme Court decision on Chevron deference. So thank you very much for joining, and we look forward to talking to you next time. Thanks.
And that does conclude today's conference. We'd like to thank everyone for their participation. You may now disconnect.